Hello everyone. Today we will discuss a company which has a huge upside, and we will also look at why I picked up this company, why there is a huge upside for this company, uh, how how the overall industry is looking, and what are the key growth factors which are involved in this company. So let's go ahead, and as you can see, the company name is Office. The whole name is Office Spaces Solution. So first of all, I will tell you why I picked up this company to analyze. So as you can see, Ashish Kacholia, who is a veteran investor. He has generated huge returns for himself and for his clients in recent years. So Ashish Kacholia has invested a decent size of money recently in this particular company, and currently he is holding 4.83% of this company. So first of all, we will try to understand what this company does. So the Office is basically it's a fast growing end-to-end workspace solution platform. So they rent out rental spaces to corporates, small startups, and professional peoples. Um, Now, as you can see, they have more than 2,000 clients. Their revenue is 900 crores, and they are spread over 17 cities. So now we will understand the whole sector. They are working in flex sector, that means flexible rental spaces. So if you can see here, in tier 1 cities, the growth rate at which this sector is growing is tremendous. It's 17%. So whenever any sector is growing in giving double digit growth, that means something interesting is happening in that sector. So as you can see, in tier 1, this whole sector is showing 17% CAGR. And if you see here, tier 2 cities, they are actually showing a more than that also. So in tier 2 cities, it is showing 26 to 27% CAGR, which is really good. And they are showing estimates till 2026. So still we have around 2 to 3 years for this growth so that we can invest or take advantage for this opportunity. Now, as you can see, the management of this company is saying that there is a huge addressable flexible market cap. So that means the opportunity is very huge for the company. So now we will discuss some key growth factors, or why this particular industry is growing that fast. So first of all is that there is a need for offices with better infrastructure and affordable ratings. And another point is that 74% of workspaces are very fragmented. So what management is saying, that this particular industry is very fragmented, and when a particular sector is very fragmented, there is a space for growth for organized player to come in, and so that they can expand very rapidly. And the main difference between organized and unorganized player in any industry is that the organized player have different advantages over unorganized player. They have more capital advantages. They are more capital efficient. So organized player can expand really fast as compared to an unorganized player. So here the company is trying to discuss their business model. So it is saying that this company is a leader in a capital efficient model, which is a managed aggregation model. So in this video we will we will also discuss their business model and how this company is unique from other companies. So here you can see there are examples of some designed offices by this company. Now we will discuss the business model of this company. So as you can see, the company follows two different business models. One is called managed aggregation model, and the second one is a straight lease model. So first of all, we will look at the managed aggregation model, because this is something unique and different. So if you can see here, a large portion of capital of expenditure is funded by the space owner or the real estate owner. So in this model, what they are doing is they most of their capex is funded by the real estate owner, not the company. And what they are doing is they are the profits and the risk is shared between the owners and the operators. So the company is the operator and the owner means the real estate owners of that particular real estate. So as you can see, the capital requirement in this model by the company is very less. That means the ROCE of this particular model will be really high as compared to the traditional model. And the payback period is basically the time period in which the company will get back all their money, and after this period all the money they will receive will be additional and treated as an additional income for that company. So you can see the payback period is very less as compared to the traditional business model. And if we discuss this another model, the more traditional model, which is straight leasing model. So in this model, what they do is they take lease from the real estate owner. They don't do partnership with the real estate owner, and they rent out that real estate. They first of all they design it, and they design it, and after that they rent out that space. They rent out that space to different clients, uh, which are small business owners and all the small startups and all that. So in this model, as you can see, the capital requirement is high, because all the design and all the maintenance is done by the company. And because of that, you can see the ROCE of this particular model is very less as compared to the previous one. And for that same reason, you can see the payback period of this particular model is also high. One disadvantage of the aggregation model is that the margins are a bit less as compared to the traditional model. So the traditional model has one advantage, that the EBITDA margins are really high, not really high, but as compared to the MA model, they are high, because the company is not partnering up with real estate owners. So all the profit they are keeping it by themselves only. But the traditional model have also some risk associated to it. That's why the company is focusing more on MA model, although the company follows both models. But they are focusing on MA model because it is less capital efficient, and they can expand this particular model very easily. And in a industry which is expanding rapidly, a company with a business model which is really scalable can take up market share very easily. Now if you see the previous track record of this company from 2021 to 2024, like they have performed really well. The revenue of this company are growing at 28% CAGR, and you can also see other metrics of the company. The EBITDA is also growing at for 67%, and you can also see other metrics as well. Now we will discuss some key snippets from the investors con call. So the con call is very important to read, because we can read and connect to the management of the company and what is the outlook of the management towards their growth. So first of all, in this snippet, as you can see, the management is discussing their occupancy rate. So occupancy rate is basically means how much time or how much number of seats, how much percentage of their seats are getting filled. So as you can see, so there generally the last month occupancy rate is 71%, which means last month means basically the new centers they are creating, the occupancy rate is 71%. But on the other hand, if you look at the centers which are older than 12 years, the occupancy rate is 84%, which is slightly higher. So you can see, as the center get more matured, the occupancy rate increases with time. And you can also see the average tenure is 46 months, which is approximately 4 years, and the lock-in tenure is around 3 years. Now this snippet is very important, where some investor is asking the growth drivers and what are the factors which will drive growth in future. So the company's management is saying first that the commercial real estate market is doing well right now, and because of that, more and more clients they are getting from the real estate sites, so that they can do transformation of that particular real estate. So in this business model, they have a capped gross margin which is 50%, right? But I will focus more on their other business aspect. So the other business part is that they're designing services and building services, and they're renting services. So as you can see, the management is saying that the Indian corporate growing, so this is one factor, and the startup ecosystem is continuing to expand. So these are two factors. So in this other part of the business, their gross margins are 18 to 20%, which is better than the previous business part. So in this particular snippet, as we can see, the management is discussing that they are expanding their capacities, and the management is saying that they are adding the capacity of 40,000 seats, and previous to this addition, the company was operating at 95,000 seats, and after addition of 40,000 seats, the company will reach to 1,35,000 seats. So now what we will do is we will analyze whole company on screener.com, so screener.in. So as you can see, the market cap of this company is around 6,200 crores. So it's a small cap company. The PE is not written here because the company is not profitable, and we will understand. We will also understand why this company is not profitable, right? I want to draw your attention towards their sales growth, which is 55%, and the sales growth in last 3 years, and both the numbers are really good. The company is trading at market cap to sales of around 7, which is slightly higher, which is okay, because if the company is growing at a very fast rate, you can't expect that company to trade it very cheap. If a growing company is trading at cheap prices, that means there is some problem with that particular company. So now we will look at their profit and losses. So as you can see, in last 3 to 4 years, the company has almost 4x their revenues, and if you see their OPM percentage, that means profiting margin, So sorry, operating margins. So operating margins are very stable, around 30%. But the problem here is net profit. So you can see the net profits are in negative. That means the company net is making losses. But let's see why the company is making losses. So if you come at the balance sheet, what you will see is, if you see the net assets, so in last 2 years, only in last 2 years, the company has tripled their net assets. That means the company has acquired more number of buildings and all the hard assets which they have acquired in last 2 years. So what is happening is, the company is trying not to be profitable, and they are reinvesting their profits uh, in their expansion, because they are very well, they know very well that once they expand their company, it will be really easy for them to become profitable. Lastly, we will discuss the investors holding pattern. So as in the starting of the video, I told you that Ashish Kacholia has already invested in this company. If we look at, if we look at the FII holdings, the Goldman Sachs fund also invested recently in this company. So somewhere the company is getting attention, and this can be a really good opportunity. So if you want to invest in this company, I would highly suggest to do your own due diligence, because you can't borrow conviction from anyone. So it's my humble request to do your own due diligence before investing. So that's it from my side. If you have any query regarding this company, you can ask me in the comments down below. And if you want more such content, more such in-depth knowledge, so you can follow my my YouTube channel also. Thank you.